Hello, and welcome to the beginning of the online instructor-led SAFE 20 course instruction. As you may recall from Aaron's introduction, my name is Christina, and I am his teaching assistant who is well-versed in mortgage law and compliance. I hope you are excited to get started on your journey to becoming a licensed mortgage professional. Let us begin by giving a quick history of and introduction to the mortgage market. The mortgage industry as we recognize it today was born when President Franklin Roosevelt initiated a series of government-backed programs designed to get the country back on track after the Great Depression. These programs were known as the New Deal. As part of the New Deal programs, President Roosevelt initiated many measures to help reignite the stagnant real estate market. The first was the creation of the Federal Housing Administration, which we will refer to as FHA. It is hard to describe the state of housing in the U.S. that precipitated the creation of the FHA. When the FHA was created, the housing industry was in dire straits. There were 2 million unemployed construction workers. Most homebuyers could not meet the terms being offered for mortgages. Furthermore, mortgage loan terms were limited to 50% of the property's market value, with the repayment schedule spread over 3 to 5 years and ending with a balloon payment. Additionally, America was primarily a nation of renters. Only 4 in 10 households owned homes. To combat these problems and revitalize the housing market, the FHA started insuring banks against real estate losses. The FHA accomplished this by charging the borrowers a small premium that would in turn provide the banks with insurance coverage if the borrower defaulted on the loan. The Federal National Mortgage Association, also referred to as Fannie Mae, was established in 1938 to make mortgages available to low-income families in the wake of the Depression. At that time, as a government agency, it created liquidity for the FHA market by buying FHA loans typically originated by banks. In 1968, Fannie Mae stopped buying government loans and became a quasi-private company. The function of guaranteeing government loans was transferred to the new Government National Mortgage Association, also known as Ginnie Mae. This essentially created the secondary mortgage market, which allowed mortgage loans to be bought and sold by investors, thereby allowing banks to sell originated mortgages for a profit and free up that capital to lend again on other mortgages. Over the years, additional government-sponsored enterprises, or GSEs, have been created to perform a similar task in the secondary mortgage market, the most notable addition being the Federal Home Loan Mortgage Corporation, which you may know as Freddie Mac. This was formed to buy loans originated by savings and loans. A GSE is a financial service corporation created by Congress to enhance the flow of credit to the market to make it more efficient. Until Fannie Mae and Freddie Mac existed, local sources were pretty much solely responsible for providing funding to buy homes. Once the local bank met its lending limit based on its deposit pool, the bank needed repayment on an existing loan or more deposits before it could lend any additional money. The real estate industry began to recover from the effects of the Depression, but the start of World War II stopped it. There was virtually no growth in the housing market during the war, but immediately after the troops came home, demand exploded. By 1946, new housing construction quadrupled to over 500,000 homes. Another trend was born during this period as 2/3 of the 15 million homes that were built were constructed in the suburbs. As the suburbs grew, the nation's urban areas fell into a slump. Under intense political pressure and public outcry, the government again decided to act. In 1965, it created the Department of Housing and Urban Development. HUD provided financial incentives to renovate and build within urban areas. Over the years, its mandate has expanded to include many facets of the housing industry. Today, the mortgage industry is tightly regulated by various state and federal agencies. Unlike the past where a borrower had a limited number of choices offered from banks and thrifts, today, borrower has access to a plethora of mortgage options delivered by a whole host of entities. Loans are no longer only made by traditional depository banks. Instead, private lenders, Wall Street investors, the federal government, wholesale lenders, and institutional lenders all have a hand in lending. With these advances, there have been some drawbacks, but overall, the way the mortgage industry has evolved has resulted in a net benefit to the average consumer. Today, more people own homes than imagined even 30 to 40 years ago. Before we go on to discuss the primary and secondary mortgage markets, we will cover the Module 1 learning objectives on the next page.